Well, ladies and gentlemen, welcome to The Scoop. I'm your host, Frank Chaparro, Director of Special Projects at The Block. And I'm very excited to have Diogo Mónica on the program joining us from Haun Ventures, where he's a general partner. But I'm excited to have you on again for the second time, and it was 2 years ago, because now you, as the saying goes, wear many different hats, right? As not only an investor in this space, but still very much involved with the firm you founded, Anchorage, which is a custodian and prime brokerage firm to an extent. And then you're also involved with Near. So you come to the table with operator experience, investor experience, and blockchain development knowledge under your belt, which is cool and unusual. So I guess we can start at a very high level and then dig into a myriad of topics. Given your literal seat, right? You're sitting in Anchorage's offices in New York, and then your metaphorical seats across your roles in this space. How would you describe the state of crypto in 2024?
It's a hard question. Lots of stuff happening at the same time. And by the way, it's great to be on yet again on the podcast. I would say that it depends which hat I'm coming to you from. If I'm wearing the Anchorage hat, look, we've had a tremendous year, best quarter ever from a revenue perspective. This year, we crossed over $50 billion of assets on the platform. We're still the only federally chartered bank in the United States that does custody and staking of protocols. And from that moment, from that perspective of the Anchorage hat, the ETFs are coming out. The Ethereum ETFs are out. Soon we're going to have staking ETFs. It's very obvious that Solana ETFs are in the future. And so to a large extent, this institutions were coming narrative is absolutely dead. The institutions are absolutely here. And this narrative about will crypto be something is also not in people's minds in terms of institutions' minds at all. It's just about the question is, how big will crypto be at steady scale? Like how big will it be? Will it be $10 trillion? Will it be $100 trillion? This is really the discussion that is in people's minds. So coming from the Anchorage institutional side, it's amazing. The things that are being built, the types of security tokens, the types of integrations with DeFi, all those projects are kind of really exciting. From the point of view of Near, Near right now, actually this week, we're launching blockchain abstraction, which is really cool, new primitives that allow you to have tokens be abstracted from all these different blockchains. So we've had this sprawl of blockchains, and now there's all these new attempts at bringing it back, which is kind of fascinating. We create all these different blockchains, and now we have to create a way to abstract them, which ultimately is driving towards like user experience and abstracting it itself. And we're also about to launch this new the final version of the sharding. We have this AI narrative coming in, which is pretty exciting. Then finally, from Haun Ventures, we're seeing incredibly talented teams. This year, the market generally picked up. I think right now is a little bit more of an lull. Might be the summer, might not be the summer. But the beginning of the year was extremely strong. We did lots of investments. And so I really hit the ground running at Haun Ventures. So it's kind of exciting all across the board. I think there's always doom and gloom, but the doom and gloom really comes from, I think, reading too much about the politics and looking at macro and hearing this conversation about recession. And it has very little to do with crypto, even though obviously like crypto is correlated in terms of price action, but extremely positive across the three roles.
Yeah, macro and politics can definitely put a damper on everything, honestly. This past week in particular, it felt like just sifting through those headwinds. It was a lot.
So the cool part is that, well, maybe not from the Near side, in which you're very exposed to basically the price, and you're to a large extent correlating some of the success of your blockchain to the price and market cap and transactions, et cetera. But from the other two hats, look at Anchorage, institutions have very long-term horizons, 10 plus years. Those are the institutions we work with. And at Venture, like this is a venture where Haun Ventures is not a hedge fund, right? We're a VC firm, a crypto VC firm. And so from that perspective, it's very easy for you to take a step back and think about, hey, I've been in this for 10 years. I've seen these things over and over again. It's very easy to take a step back and take the long view.
Well, I think there was a lot of data out there that suggested that institutional market participants were buying the dip, as it were. I know I saw some interesting data out of, I think it was Falcon X, which saw prop desks, hedge funds and venture funds all sort of coming in as net buyers. to buy up the dip.
And not just of spot, by the way. Now we have more structured products. We have just Superstate launched, their carry trade products. We have Bitwise with structured products that institutions are interested in. We have assets that stake, so you have yield that is being generated by some of these things. There's more complexity, and so there's more interesting things for institutions to do with this. A Bitcoin only world was, interesting, but Bitcoin spot ETF is very trivial. Now everything else that is happening really is bringing institutions to the game. The fact that you can wrap these T-bills and have instant liquidity on weekends through Biddle, these wrappers like Condo, again, Superstate, Bitwise, all of them are speaking to institutions on a daily basis, getting distribution. We saw all the news about Morgan Stanley distribution. All these things are really exposing institutions into crypto in a way that they're very familiar with, which is these types of structured products that have different characteristics, different risks, different upsides. And so that also allows them to come into crypto without just buying spot, right? They can come into crypto in many different ways.
Yeah.
Which they couldn't 3 years ago.
They couldn't. And to what extent, does that solidify the involvement of these new market participants? Because I think when people think about venture, the last cycle, it did feel a little bit like folks got in and then pulled back. If you think about some of the larger non-crypto venture firms post FTX, right? They kind of receded from the market, I would say. 2 years out, do things look different, or is there more space for sort of a Haun Ventures to, sort of elbow their way in, as it were?
Yeah, so I think it's interesting. So again, I wasn't in the venture seat 3 years ago, the last cycle. I was in the operator's seat. And so right now I see like all three, and I wasn't even the chairman of the Near Foundation. So these are the three jobs that I'm keeping, and I gave up everything else because it's enough. 3 jobs is enough for me. However, let me tell you the following, which is kind of a fun fact. But right now I'm sitting here, and I believe that I'm the only crypto founder that is a GP at one of the large crypto funds. And so it was very surprising to me when I realized this fact, which is, of all these other funds that are out there, nobody has been a founder of a successful crypto company. And so this is very different, having that type of insight into the market. So I describe myself not as a venture investor. Honestly, I can put the VC hat and say, no. I'm an engineer that allocates capital. That's what I am. I am not a VC. I'm an engineer that allocates capital. And I bring this founder mentality and this ability to have seen 7+ years of Anchorage, the ups and downs, how to run a company where revenue is directly correlated to the crypto prices. It's kind of insane to think through a company whose revenue just disappears like clockwork. Every 80% of it goes away every 3 years. And how do you deal with this? And how do you deal with the volatility? How do you deal with cultural issues? It's very different. It's like entrepreneurship in hard mode to a large extent, to have this type of thing. And so the way that we've been able to be competitive in the market is, of course, look, the Haun Ventures was founded by Katie Haun. Katie Haun has such a great reputation, federal prosecutor. She puts these people in jail. Her reputation is completely immaculate. She's a force of nature. She's a deal maker. She was at a 16Z. She was the first board member, independent board member at Coinbase. So she had a great seat. So the venture firm was already doing tremendously well. Now you add on a founder type, and this is like a killer combo. So in the sense of elbowing in, to your point and to your question, it's actually been fantastic over the past few months, just because people are desperate for other folks that have executed in these markets, especially regulated markets, and have succeeded in them.
Yeah, I can understand how that sort of guidance and counsel could be extremely
and
useful.
Just empathy,
yeah.
Not just the guidance and counsel and experience and intros, but empathy. Like, hey, I've seen it. I've been talking to these regulators, and I felt that. Especially if you think about like this current administration, which is, as you very well know, actively adversarial towards crypto. Like I felt it. I felt it myself.
So walk us through your journey, right? Because you did have a life before crypto, before finding launching Anchorage.
If I did, I don't remember it.
I know, right? Feels like ages ago. Walk us through.
I can run it real quick through how I got here, and to a large extent, I've actually in I think, in a very fair way, rightly so. I've been in crypto for almost 20 years, and the way that I can say this, when the Bitcoin white paper came out in 2008, 2009, is because look, I was born in the US, but went to Portugal when I was very young. And I ended up doing a master's in a PhD in something that was useless 20 years ago. But now it's very useful, which is distributed systems. Turns out that all of blockchain is distributed systems. And distributed systems was really an economic pursuit for somebody that loved security. So security is always been my passion, computer security. So I ended up doing a PhD in distributed systems and working in Byzantine fault tolerance. I was doing something that I called crypto computational resource tests. But it turns out there's a way better marketing word for it called proof of work. But it's still based on Hashcash, still based on the same principles. So I was working in this field for a long time. And that's part of the reason why I think I can say that I've been working on it even before crypto was crypto. But I ended up being an early employee at Square. So Square from out of Lisbon.
You joined them you built out their card swiping infrastructure.
So I'm actually on the patent of the first encrypted credit card reader, which is pretty awesome. Jack Dorsey is the main inventor, but I'm the patent of that. And I joined Square. I was employee 40. And ended up leading the security team over there for 4 years. And in fact, it was at Square almost 15 years ago that I met my co-founder, Nathan McCauley. So we joined the same week. We worked together at Square for 4 years, led the security team over there from Series A company to $100 billion publicly traded company. It was such a fantastic journey. And then we went together, Nathan and I, to Docker, which was this different type of company, but software containers. It runs off basically every single server on the internet right now is running Docker containers. And we added a lot of the security components to it. And then in 2017, there was this crypto fund that had forgotten the passphrase to a $1.5 million Bitcoin wallet and offered me 20% if I could break into it. And that was the introduction to the business, right? Very sophisticated and competent investors were not very sophisticated or competent when it came to private key management. And so that was a pretty great introduction to it. Started doing consulting until I realized it was a full-time business. And that's how Anchorage really came to be just over 7 years ago.
I mean, that must have been a really interesting time. I mean, basically, you weren't a founder, but being that early on a team it does lend itself its own set of experiences that probably would be useful for some of your portfolio companies. But what were some of there's got to be some crazy stories in building out infrastructure like that.
Oh, there are definitely crazy stories, but I think that the ones, so it's kind of interesting. It leads me to a lot of my people, especially on social media these days and on LinkedIn, they have those failure stories of how people fail and like what you can learn from somebody else's failure. I'm very much of the opinion that you can learn very little from these failures because you always misdiagnose the reason why things fail. And really you can not only, but primarily only learn from successes. And because regardless of the failures, the success lends itself. Doesn't matter what you did wrong because clearly the things that you did right were right enough for you to lead to success. And Square is such a story of that, where obviously there's lots of misses and there's lots of stuff that were done incorrectly, but it's such a success at the end of the day that the things that we did must have either contributed or at least that weren't bad enough for us to fail. So there's lots of stories there, and including at one point we were working mandatory Saturdays because we had this big coffee shop chain called Starbucks that wanted to migrate all of their credit card transactions onto the onto the Square, Freudian slip, onto the Square's platform at the time. And we had to rebuild the whole platform from scratch, from little data centers. There was no cloud really, from data center scratch, from the machines to the software to the whole thing from scratch to support this. So it was really fun because it was mandatory Saturdays. And when you're working 6 days a week, as you know, Sunday doesn't really, Sunday is basically the day before Monday. And it's also like the day after your Friday because you end up working every day if you only have one day off. You just work less on Sunday. And so it was really fun because those are my best memories from the trenches. It creates
a whole different type of Sunday scaries.
100%. There's no Sunday scaries.
Happen maybe Sunday. Yeah, because
there are no Sunday scaries.
Because your weekend's just
That's
one
right.
day.
It's just one day and you're working, but you're just working less. And look, it was really intense. And it turns out that intensity is the thing that you need to form these relationships. In fact, so many billion-dollar companies came out of that Square team of the first 100 people. There's lots of them. There's at least 7 unicorns that were created out of that initial team. And that's fantastic. And we all have a great relationship. And I've been lucky enough to do angel investments in them. And really was that intensity and the culture that we've created and small things that we've candidly, some of them copy pasted or created our versions, but really inspired by the weekly meetings at Square and how it felt on a Friday afternoon to do the whole company, the whole hands, and presenting to the company and the types of things that we talked about and the cultural elements that were created around. We're aligned on what we're building, and we're very proud of what we're building and working extremely hard. So those cultural elements, we took them to Anchorage. And I think we supercharged them. And it's one of the things I'm the most proud of still today. But there's lots of stories. Obviously, I was there with Keith, which is very known in the venture industry at the time. I remember this story, and it was now 13 years ago or something. I'm on a micro kitchen with Keith, a boy in the micro kitchen on a Sunday night, I believe. Sunday night, I'm in a Square micro kitchen, and we're both getting, Diet Coke, or I think at that point I was really into Harmless, that coconut water. It's incredibly expensive, but we had it in the fridges because it was startup time. So I was drinking Harmless. Keith, I think, was drinking Diet Coke or something like that at the time. And we're just chatting about things. And he said, Diogo, I have an idea of something that I've always wanted to build. And then he proceeds to describe, think about a website that has a form, and you go in and you put in an address, and it gives you an offer for your house in 5 minutes. And so he describes Open Door, and it's a basic iteration 9 years before Open Door was a thing, or 7 years before Open Door was a thing, that he kind of like ended up creating to the world. So being surrounded by people like that is incredibly inspirational, and really gives you a bar that you want not to just meet, but you want to surpass. And that really makes you like work extremely hard and have just a different type of viewpoint of what working hard is and what being successful is. And that's the type of thing that is really exciting about those experiences.
How do you not only transfer some of those key cultural elements that translate into success from one company to another, but how do you also do that and then preserve it through the different stages of a company, going from 10, or in your case, 2, right, to then 10, 40, 100.
400 now.
What does that look like? 400 now, yeah. How do you preserve that, if it's tenacity, if it's I think you used the word intensity, how do you preserve things like that?
I don't think there's a formula that I give. And in fact, I think one of the things that venture investors give too much of is unsolicited advice. So for me, it's like I'm always 1,000% willing to brainstorm on these things and tell you what I've done and tell you what we've done and what has been successful. But it doesn't apply evenly to all companies, because the culture really starts from the founders, and something that is just natural to me doesn't come natural to some other founder, and so they can't keep it, right? There are things that you have to keep. Let me give you an example of Anchorage's culture that, as from the outside, sounds corny. And in fact, coming in first day,
it might be, but that's okay.
And that's okay, because that's how culture are built. First and foremost, you need to realize, Frank, that you're not building culture. You're building a cult. Cult is part of culture. You are building a cult, and so you should proceed accordingly.
And is that for retention, right? I mean, as a company, especially in its earliest stage, like, you can't necessarily pay a ton. So to keep people, you give them skin in the game with equity, but there's also there's skin in the culture as well. I don't know if that necessarily makes sense, but
yeah, no, it makes a lot of sense. You create an environment where they can do their best work and they feel like they're contributing to something themselves. And that's where the cults really come in. Look, it's a set of norms. Many of them are different and are distinctive. Culture really is one of the distinctive things that you have from other companies. So it can't really be the same. Like, oh, we have integrity. It's not part of your culture. Like, everybody should have integrity, right? So culture really and the cult are the things that are defined. I think the part that you define it is you define it for the things that are different. And you have to be consistent, and you have to find something that is yours. And then whether it works or not, it doesn't matter, because you self-select into it, right? People self-select into your culture. And that's very important. And so I think a lot of people sort of open up these cultural elements too early and are willing to compromise on them too early without having this like strong, like burning core of culture that then really like is a center of gravity that brings people to it, versus not having a center of gravity that's strong enough that then your culture starts like going in all sorts of directions that you can control. So for us, this is a very concrete example. And this is, again, something that Nathan and I put together, and we still do it this day, 7 years after creating the company. Every Friday, we have a company all hands meeting. that is highly produced. It is the most expensive hour of our week, where every single person, almost 400 people now, spend an hour in this meeting. It is the most expensive meeting. It's millions of dollars spent on that 1 hour that people could be doing something else of opportunity cost, dollars of opportunity cost. And highly produced, has a very concrete structure. And the structure is something that
I was like, where is this meeting happening, in the Four Seasons? Or
No. Well, in the beginning, it happened in person. Now, obviously, it's digital. And again, it's inspired on something that Square had at the time, Town Square. But at the end of this meeting, in particular, something very different that we had never seen before done and really have done is, at the end of this meeting, there's a 15-minute slot that we called Anchoring Ourselves, where a different person from the team tells a personal story to the company. And so it's a very vulnerable moment where you're telling a personal story and how it influenced your career and how it influenced Anchorage and some learning from it. But I can tell you that this sounds corny, but from 7 years ago to right now, we essentially have missed very few Fridays and very few of these. And the company has gotten to meet each other through stories that, candidly, there are stories in which people have to turn off the cameras because everybody's crying and bawling because they're so, about deaths in the family, about drug addiction, about everything. And then there are stories that are extremely fun and they're like unexpected and crazy. And it really allows you to meet your collaborators in a way that is very genuine and very vulnerable. And that has created like this culture sync and this cult-like thing around how we behave towards each other when you're talking to somebody that you may never meet. Say you're in engineering and you never meet this particular person in legal or finance or compliance, but you have heard them talk about their life and talk about their kids and talk about their struggles. And immediately you have this affinity of like this feeling of like you know them, even though you have actually never talked to them in the past. That immediately creates empathy, immediately creates a team. And so the things like that are things that matter deeply. And for us, it have worked extremely well.
So, I mean, this is a sort of, this can apply to any type of company, not necessarily a crypto company. You need a strong culture. The way you describe it, right, is building out a cult. It's almost like a mini country, right? I think about at the block, right? Like we even have unique ways of communicating with each other that is different from other companies. We have specific company memes and emojis, right? If you think about like how different societies have different languages or interacting with each other. So there is this interesting element of it's not like a religious cult, but there is some cult-like elements. When I think back to my, anthropology courses in university, I get the point that you're making. Build a cult.
And by the way, let me just make the build a cult. And the further point of crypto requires it. Crypto companies require it even more
because of the power of memetics.
And not only that, like if you have a company in which revenue goes away and the crypto market goes away every 3 years like clockwork, you will have massive amounts of churn if you haven't self-selected for people that have some intrinsic motivation to stay. So it is not a normal company. It is not a SaaS company that, yes, revenue goes up 10%, down 20%, whatever, but people like the product and they sort of stay on. If it is a crypto company, there's been companies in crypto. And I think one of the big examples that is given out is, Coinbase, which is one of the big behemoths that have had like 40% churn, 50% churn in a year. So you coin flip in a year, and coin flipping, the person next to you may not be there. That's a crazy amount of churn. And that's because you haven't self-selected into crypto for the intrinsic motivation. And so building a cult and building a culture in which people are aligned on what they're doing and aligned with what the company is doing and have this intrinsic motivation to go on. Otherwise, you have massive amounts of churn. And it's extremely hard to run a company with 50% churn.
So it applies to most companies, but it's specifically important for crypto companies.
That's right.
What other types of what other specific to crypto elements are important for building out a company?
Well, there's many of them. Number one, treasury management is extremely different in crypto, especially if you're taking or participating in staking upside. If you are participating in, you're taking a cut, you're taking a percentage. How do you do it? Do you keep the crypto? Do you not keep the crypto? How do you manage treasury management? Is a pretty interesting one. Another thing is, how do you charge? In a lot of businesses, it is fantastic for you to be part of the transaction. Say in the Visa network, the 20 bips that they actually get on transaction is fantastic. It's dollar-denominated transaction. You're getting the return for the network. All the network effects that you have, you benefit from the increase in gross payment volume of the network. However, in crypto, that it leaves you highly exposed to the market changes in the market volatility. So now your revenue has the same volatility profile as crypto itself, which is not something that the public markets are going to be looking at very favorably. So how do you turn that into recurring revenue? It's a different thing. It's not novel in the sense that nobody's ever done it before, but it is different in the sense that you have to actively think about it.
Well, no, I mean, it's you mentioned Coinbase, right? I mean, that is somewhat their revenue story. They went from a 90%, if not more, transaction based revenue business to, I think it breaks down something like it. Now it's 30%, maybe. I haven't checked the earnings that were a few weeks ago, but you saw in that company this story of building out a reoccurring revenue business, whether that be through, I guess, custody fees, or whether that be through something like the revenue they make from USDC, non-trading revenue, right? I think
Coinbase
that's something
that's right.
Coinbase Cloud, yeah. This is something that most crypto companies need to think about, considering this is a very payments transaction-based industry, right, at its core. And I'm sure a lot of companies will go through a similar evolution. I'm sure Anchorage has gone through a similar evolution as well.
That's exactly right.
What advice do you give to, thinking about these evolutions? What are some of the ways to ensure success at the end of the road?
Yeah. So look, it's one of the major advantages. We've talked about how right now I'm the only crypto founder that is a GP at a large crypto fund. This experience is part of the reason why I think a lot of the founders want to work with me specifically and want to have me on their board, is because I have seen it, I have done it, and it's not the most complex thing in the world, but it requires thought and it requires you to actually see ahead of the curve. And it could be as easy as thinking through mechanisms of charging that are turning a percentage of the volume into fixed fees, so base fees plus upside. And then you get to control and you get to model out your revenue, and you can actually choose, hey, I want 50% upside to the market, or I want 30% upside to the market. And you can sort of like vary with the slider how much upside you actually want and how much volatility you want in your revenue profile. And then you always can find add-on services that are charged in a recurring revenue basis that are not run rates. And then you have to manage across your verticals. If you add a new vertical that is primarily going to make money out of run rate, then you move the slider on these other verticals that you have and on these other products, so they actually have more recurring revenue. And when you have volumes that are going up, and you're in a bull market, that's the time to renegotiate a lot of these contracts of saying, hey, look at you paying me millions of dollars a year.
That's the time to put your name on a sports arena. That's when you pour money into marketing. No, but it's funny because I don't want to pick on anyone in particular, but when we do get to those peak moments of the market, a lot of companies, when you're making money hand over fist, that then breeds a lack of discipline, perhaps, and then the marketing dollars get splashed everywhere, versus maybe thinking through some of the things you're describing.
Oh, 100%. Like when the arenas start having crypto company names, that's how you should be turning your run rate into large contracts of recurring revenue. Slash it in half, make it a 3-year contract, and say, lock in, sign this agreement, and let's go. That's when So that's
that's funny. No, but it's pedantic, esoteric business changes that can make a huge difference, and just being thoughtful about where you are in the market cycle.
That's right. And especially because, all these things compound, right? So if you didn't do culture right, and if you didn't do this right, then you're going to find yourself in a situation where your revenue is going to disappear 80%, but your main cost will continue to be people, and they won't go away. You still have your 100 employees or your 400 employees or your 50 employees. And so all of a sudden, maybe you were profitable and you're no longer profitable by a lot. And there's nothing you can do to change it over the short term. So all the things that you needed to kind of have some control over it, you have to do them before. Or you have to go into mass layoffs, which are horrible. Or even if you have enough capital on the balance sheet to support that until the next bull market, you're going to see churn because you didn't do the culture right. And so these things compound on each other. And that's why I say crypto is entrepreneurship in hard mode. There's a lot of things around the volatility of crypto, in the ethos of crypto, and the cultural elements that around conviction of crypto because of the market cycles that make it extremely hard to build a successful company.
Well, we talked a little bit about culture. We talked a bit about treasury management, but also more broadly revenue and being thoughtful about revenue and evolving the revenue model. Product is another component, right? And I think one issue that so many companies have is they pour resources into a specific product. They hire the devs to build it out and doesn't quite get product market fit. So then they double down and ignore the sunk cost fallacy that we were all taught when we were youths. How do you avoid that? How do you sort of, not just in some instances you have to reinvent the business model, but sometimes you also need to just either reinvent the product or throw it into the dustbin of your corporate history?
Yet another thing that in crypto is extremely hard. Look, tokens.
Yes, isn't it? Why is it? It's especially hard.
Well, if you think about tokens have a superpower and a super weakness. The superpower of tokens is the ability of overcoming the a cold start problem. So you can bootstrap these network effects artificially because you have skin in the game. You create an incentive, and we've seen over and over again that you can bootstrap these networks. But it has a super weakness. The super weakness is the fact that it hides product market fit. A lot of the metrics that you're looking at are not real. They're incentivized. And it's very hard to distinguish whether you have real product market fit or not real product market fit because you use the superpower of the token.
You have token market fit.
You have token market fit.
They just want that's all you have.
And so it's extremely hard, to your point, to kind of like, see the forest for the trees and look at it, which then comes with experience, and it comes with what really are the elements that you're looking at. It can't be TVL. It can't really be transactions. All these things are easily manipulated. And so you bring also a lot of the, hey, you're building a real product. If you're building a real product, if it's a consumer product, let's look at consumer metrics. If it is a B2B product, let's look at B2B metrics outside of these incentives that you've created. And in many cases, it's kind of hard.
But to your point, it's also difficult, right, to ignore some of those more token centric metrics because you don't want to miss out on a nice 100x. But I guess that's less relevant to a venture firm, probably to be more relevant to a liquid conversation.
Yeah, and look, that's why it's also so hard to build enduring businesses, and the graveyard is so massive here. And also, you have another thing, which is recently this has changed pretty dramatically, but until a few years ago, I think the founder quality in crypto was distinctive to potentially like the less experienced side. The people that were coming into crypto were less experienced. There were less repeat time founders. There was less of this traditional Silicon Valley crowd that had built real companies with real revenue that were coming in. And again, the tokens made it even worse because it attracted a type of founder in a higher percentage, which is, hey, it's a superpower, super weakness. And if you have these abilities, obviously, then people that are want to exploit them without doing the hard work of actually building a product, then they also come to the easiest manner of deploying some of these products. So that difficulty has sort of been overcome. And you talked about like this period of mayhem that we had a couple of years ago with all these companies and all these names on stadiums. And that's really washed out. And I think even the venture investors are behaving differently. And even many venture investors have sort of been wiped out, and due diligence is back in fashion.
So let's talk about just venture specifically. Obviously, it is summer, so you do get that summer lull that you described. But generally speaking, this year, it looks like there's been quite a bit of deal flow. How would you describe the categories of companies? You obviously talked about the robustness of these founders that are now newly operating, but obviously have a bit of history starting companies. So how would you describe sort of the number of deals, the category of deals, and the robustness of the entrepreneurs?
Yeah. So, well, number one, there's always, and crypto has always been like this, but this year was no difference. There was a lot of Me Too type companies where everybody wanted to build a DA layer and everybody wanted to build a layer 2 that did something. Everybody wanted to build an AVS and everybody wanted to build a Lido. And everybody wanted to build liquid staking, and everybody wanted to, all these things sort of like are if you have different blockchains, and different blockchains are different ecosystems, and there's no easy way of actually bridging one to another in a trusted fashion. So there's no layer of abstraction on top, which now again with blockchain abstraction, things are coming in that direction. But if you don't have it, then all of a sudden you need a DEX and a perps DEX, and you need your lending protocol, and you need your whatever protocol deployed on all these things. And that created a lot of space for new companies to be created that are basically, I'm like X, but on Y blockchain. And that was very much something that continues happening and will continue happening in the future, is the fact that every single new blockchain creates a set of other new companies because it creates a new ecosystem. And that's actually something that I, A, struggle with, but B, is kind of fascinating, is because of the decentralization push for crypto, for example. Every time there's a new blockchain layer one, or anything really that requires staking or security participants, you have new companies being created, because by definition, you don't want one big participant or a single set of participants. And since it's a new blockchain, the big participants in the space and the big validators and stakers and custodians might not get there soon enough. And so every time there's a new layer one, there's a new ecosystem and a new set of companies that will get delegation from the foundation enough to create companies around it that then will compete with the other blockchains, because they'll have to expand their repertoire, or else they're not a company, right? They're like a single blockchain type of thing. So that dynamic is something interesting that is existed and exists in crypto, and that you've seen a lot this year. But outside of that, there's also been really cool new things that have been created.
That's such a good point. Just to double click on that quickly. What then can get you or someone in investing allocator capacity excited about the Jito for X or the Jito for Y or the Jito for Z?
Yeah, in that particular case, when it's sort of a thing that already exists and you're trying to apply it, it has to be something that is truly either a team that uniquely qualified to do something significantly different or apply the same concepts in a way that is just not, apply the same concepts, but in a way that is not just a Me Too network. And usually do so in a way that you have line of sight of how they're going to dominate on the biggest blockchains, not how they're going to dominate on this like little corner of the world. But I do think that it's a lot harder to get conviction around things like that. Even though when you think about a DEX, or you think about these, there's so many of them, and it is one of the product market fits of crypto is trading, as we all know. And so there's space for many of them. The things that I really get excited about are new primitives, new blocks, things that we haven't seen before, ways to solve real problems. Hey, there's many blockchains, so how do you unify this back? Or we're sort of all building the same thing, whether they're monolithic blockchains or whether these vertically integrated blockchains. We're sort of like all going at the same thing and trying to get as many TPSs and trying to get low latency and trying to get some of these like Byzantine fault tolerance elements and characteristics. We're sort of all going towards the same thing. And so really being able to see new primitives or being able to see new unifying theories of the future of the world, those are the things that are really exciting. And then there's products, of course, and products are cool. There's cool products. We've invested in something, in things like Zora. We have investments in things that are real, that consumers are actually using, and that you can just do the normal type of due diligence and get excited because there's just cool products that are being built by cool founders.
Where do you think consumer applications are really taking off in crypto? We're both old enough to remember the great Hassingon days of the NFT boom of 2020 and 2021. That seems to have subsided a bit.
By a lot. But that's going to be a bust and boom type of economy too. I do think it'll come back. It'll come back maybe in the same way, maybe in a different way. But the central primitives of that, of ownership of digital assets, I think, are core primitives of the internet. So the more people use the internet and the more we have all of the tools for self-custody and the ability of trading these things, just makes a lot of sense to have this financialization of everything. At the end of the day, it makes a lot of sense. So I think those things will come back. But there are lots of products in stablecoins, as you would expect. And in fact, there's this weird thing happening where stablecoins have achieved clear product market fit on the B2B side, on the B2C side. There's lots of apps. We're seeing this emergence of what I call crypto neobanks, which are banks that offer the exact same products as a traditional bank, but at no point do they ever touch fiat. The bank account is USD, but is actually USDC. The investment is a yielding stablecoin. You can have exposure to, other types of investments to wrap tokens. You have the ability of trading directly and having your broker directly on a DEX. You have Bitcoin potentially as your like long-term savings. You have a Visa credential that you can swipe and it's settled in stablecoin. So it is a bank. It is a bank-like relationship, or at least the relationship of the products look like bank products, but at no point do they ever touch fiat. So you can iterate a lot faster. These are emerging left and right. And that's really cool. That is a clear consumer application. It's sort of like we're reinventing fintech on crypto rails. And that's really a consumer product that sees a lot of traction and is seeing a lot of traction, which is kind of fascinating. The other thing that's fascinating about this particular space is that stablecoins are very fundable by everyone. To a large extent, non-crypto funds look at stablecoins as one of the fundable things. And so there's almost like a peeling of the stablecoin infrastructure and stablecoin-based companies and fintech companies from the crypto venture remit. And so traditional firms are also going after it. And so kind of funny because every time you have something that gets a mass product use case and consumer adoption and it's like sort of non-crypto almost, then all of a sudden like it gets peeled apart. And really a company like us that bridges both worlds in the traditional world and competes with the large brands and also competes with the crypto brands by being crypto native and having this like founder experience and operating experience, just very traditional type of venture experience that help build real businesses and B2B businesses and B2C businesses. We see that. We see that in the stablecoin world, we compete with the traditional firms, and in DeFi world, we compete with the crypto native firms. So there's almost like a separation of these investing opportunities, and things that get product market fit sort of become like generalized venture, and things that are still very crypto native and like DeFi specific are still within the crypto realm. So that's also something fascinating that is coming from this.
And it speaks to the extent to which crypto venture firms almost have to be very generalist in nature, given what crypto touches, which is most things, and it's increasingly being intertwined with artificial intelligence as well. There's a lot of buzz around that intersection. Do you see this as just a narrative, or are there real world applications that you see that hold some promise?
Look, AI and blockchain are made for each other. Artificial intelligence creates digital abundance, and crypto enforces digital scarcity. They really are like, they really are perfect for each other. But now, if you ask me about the current use cases and what's actually being worked on that makes sense, I would say that yes, AI and crypto is primarily still narrative. And you can go through like the types of things that are happening. I don't think, it makes a lot of sense for you to do decentralized model inference. I don't think it makes sense for you to do decentralized model training, but it does make sense for you to create using crypto incentives and maybe stable coins, so crypto payments, crypto payment rails, for you to do marketplaces of discovery of GPUs and of inference. But the marketplace element, it's the most important thing that crypto is solving for AI, not really the trustworthy, zero knowledge inference in a decentralized manner that nobody can influence. That doesn't really seem to have any product market fit. Or I don't see, there's narrow use cases in which it may make sense, but I don't see really a clear need for that to exist. And so really the places where it will come, more obviously, that is not quite there yet, but it is for data collection and attribution for training. That's a very clear one. Royalties tracking and distribution, intellectual property tracking. Those are the places where it really makes a lot of sense. It's like this coordination layer on top of artificial intelligence, but they really are perfect for each other. And there's lots of use cases, day-to-day use cases around, look, disinformation. We're living in this age of Gen AI is really, evolving on a day-to-day basis, and we have a bunch of wars, and these two things are coming together, and we're already seeing the impact of it, and we have the perfect solution. The cameras right now, the camera manufacturers right now are putting private keys inside of the actual cameras. And so they can have a PKI, a public key infrastructure, that tells you whether an image came from a particular camera. And guess who would be the perfect technology and the perfect type of product to distribute the actual root of trust and magically tell you when you open the New York Times if this image actually came from a war zone and came from the Ukraine or came from Gaza or came from wherever right now we're having conflict versus, you being subject to that picture just being from something completely different. We have the technology. We know how to do it. It's just, about really marrying these two things. It's all there. It's just about marrying these two things. And so it seems very obvious that these things will happen. And I will even tell you more. I will tell you, like, one of the things personally, as a venture investor, that I'm most excited about, and it's not a short-term or medium-term, maybe even type of investment, is like this long-term narrative, but it is what I call the positive externalities of crypto. Venture investors in crypto are pouring billions of dollars into fundamental cryptographic research and zero knowledge proofs and fully homomorphic encryption and all of these primitives that, let's be very frank and clear, will create more value outside of crypto than inside of crypto. The people that will benefit the most from databases that are fully homomorphic or zero knowledge proofs won't be a blockchain. It really will be a traditional database, a traditional bank, a traditional corporate. If you can have data that you can query on top of whatever you want, but you don't actually have the ability to read it, then it means that all of these hacks on banks and insurance companies and telecoms won't actually have the major impact that they're having right now, where all of our credentials and all of our PII is constantly being leaked because the business need is really against the technology. The business need tells you that you should collect the most data, and the technology says that by collecting the most data will be vulnerable. So people have been talking about how data is the new oil, when in fact, what we're finding out is that data is actually toxic waste. The more you have and the more you accumulate, the likelier you are to die of radiation poisoning. That's what's happening right now. And so this general trend of investing in cryptographic primitives in just general companies, database companies, SaaS companies, cloud companies, using these technological evolutions in progress to build safer systems outside of crypto, that's going to happen. And so to your point, I think crypto companies will need to be generalist companies, and they will be the first ones to see, progress with hardware that does zero knowledge, that actually has utility, or that is actually helping some use case come to fruition, and then invest in those companies, even though the company itself is not directly building, is not issuing a token, is not building something crypto native, is just using the zero knowledge and the fully homomorphic encryption to make something else happen, or more effective, or safer. So that's really like one of the long-term narratives that I'm the most excited about, that I keep peeking into and looking in the traditional worlds for venture investor returns.
And long-term being 10 years or? Yeah,
long-term for me is 7 to 10 years. Yes, for sure. One of those. A decade is a good back of the envelope number.
So we're getting to the top of the hour. So maybe we can wrap up by thinking about maybe some of the trends or themes that you see shaping the rest of the year. What should people expect?
One of the things that is going to continue happening is this incessant drumbeat of new financial products being created in crypto, out of which the ETFs, and specifically the spot ETFs, and the spot ETFs that do staking, are going to be one of the biggest ones, right? And I think that's just the unrelenting drumbeat of crypto being more accepted in traditional finance. There's going to be structured products. There's going to be indexes of the top cryptocurrencies. There's going to be the double leverage, the double short. There's going to be all of these things that are going to come, and the financialization of the financials of crypto will continue happening. And so you can definitely see that one. The other aspects that are clearly in vogue now is this view of fatigue of overinvestment on infrastructure and the sprawling mess that it is developing in blockchain right now. And so these unifying plays are really being played, whether it's blockchain abstraction, whether it is trustless bridges, whether it is ways of getting consumer experiences such that they don't have to know which blockchain their stablecoin is on. They should know that is a dollar in a digital dollar, and then the auto routing and the redemption and the transfer should go to whatever blockchain it needs to go. There shouldn't be an individual that is installing a bunch of different wallets and doing all sorts of crazy operations to be able to get USDC on Ethereum to USDC on Solana. That makes no sense. And there's so much sprawl that there's very much of a need of unifying infrastructure. And whether that's crypto native infrastructure, whether that is blockchains dying and us coalescing and concentrating over some other ones, whether it is really good technology like blockchain abstraction that is decentralized and just abstracts conceptually these different things, and thus you have one single API. Nobody knows exactly what's going to win out, but that becomes a really interesting area for you to spend your time on and focus on. Maybe finally, there's stablecoin infrastructure right now in many companies that are incredibly exciting, growing 50% month over month, maybe from a low base, many of them, but these are real venture returns and venture growth companies, exciting companies people coming from fintech, traditional companies like X Square, Stripe, etc., building awesome infrastructure that is built on crypto rails and has major advantages over traditional payment rails, whatever. And so that's really exciting and something that is going to continue happening because you will see these companies raise and announce bigger and bigger rounds, and that's going to catalyze the space even more.
Keep an eye on stablecoins. That's good advice. Thanks so much for joining the program. It's good chatting with you.
Thanks for having me, Frank.
Of course. And we'll have to talk to you again soon.
Yes, we'll do it every 2 years.
I think that's a plan. That's a plan for me. Take care.